Good evening, everyone, and a warm welcome to all of you. This is our second attempt to reach out to you in terms of our portfolio construction, their earnings, quarterly call for all the investors, for all the distributor community. When we were sitting down and were beginning to think as to what should we cover in this particular call, apart from the stocks that we are covering, we opened the floor for everybody to ask questions, and we approximately got 50 to 60 questions, which we will be addressing today. So there is a lot of stuff that to be covered today. Apart from our portfolio stock, we are also covering market outlook, our thought process about the portfolio construction for the stocks that we have entered in this particular quarter, exited this particular quarter, and also what is the theme that we are looking to be invested into over a period of time. So without taking much time, I will hand it over to our CIO, Umeshkumar Mehta, who is also with us. And also on the panelist list, we have Nirali, who will be taking it over from Umesh Bhai. And also we have Dhawal, who is our dedicated overseas portfolio manager. So we have a complete pack house and a lot of things to be planned out and to be spoken and to be conveyed to all of you. So without taking much time, I'm handing it over to Umesh Kumar Mehta, who is our CIO. Over to you, Umesh Bhai.
Thank you, Viraj, and good evening to every one of you. A lot has been said about this rally, whether the 2,700 points rally in Nifty, will it sustain? Is it a dead cat bounce? Or again, market will fall? So let me straight away come to one image. Image is worth 1,000 words. That will give you an idea where we are in terms of global interest rates, inflation expectations, how equity flows will emerge. So, Nirali, if you can just put up that slide, uh, which will show. So, this is short-term and long-term bond yield in US market. If you can see the upper chart, it's a 2-year bond yield. So, that is typically is a shadow indicator. This largely follows Fed. But down below, if you say, that's a 10-year yield. And that this is a leading indicator. So if you see the difference between the two is recently of late, 2-year, the shadow indicator is rising. But leading indicator, 10-year bond yield is not rising with the same velocity, with the same force that the 2-year is rising. So what this indicates is that we are nearing the cycle of US Fed tightening. So maybe in next meeting, we will see around 50 bips or 75 bips rate hike. Moment that happens, no, thereafter we don't see a much upside, and globally interest rate cycle will turn. Inflation is under control. Natural gas is down. Crude oil is down. So all these macros in next 2 to 3 quarters will become very attractive. So that's the time market, or that's the time we will see a lot of euphoria, people talking about, wow, equity is great. But today is a time to, for those who are contrarian or those who want to accumulate, today is the time. Although markets have run up quite a bit, but I think still there is a lot of room to go on the upside. So I'll just briefly cover 3 points. India as a country, as a company, out of 195 companies or countries that are globally available, India is the strongest and the fastest growing economy, young economy. I think this factor is very important. When we see global money that are chasing 195 companies, for that matter, countries, India as a country is an outstanding country, because the impact of Ukraine-Russia war was minimal. In fact, it we had benefited out of this entire episode. Supply chain, logistics, supply chain. New manufacturing emerged in India. We were able to buy crude oil at a lower price and therefore could control inflation. So there are factors, and even for that matter, so the impact on currency was also minimal. So all these factors combined does make India an outstanding company for global flows. And as I told you, 2-year, 10-year bond yield, this indicates that we are at the fag end of the Fed tightening cycle. And the moment market realizes this, a massive amount of money will start flowing. And since last 1 month, we have seen FIIs have started to bring in money. but this is going to accelerate and continue. So this is where India as a company, as a country, we are today. So there is still a lot of runway to go. Although we have had a 2,500 plus rally in the Nifty. Second point, see attractiveness of money. Once money starts flowing in, so where will the money go? China, Russia currently are no place to go because of geopolitics, because of other things that you all know. Taiwan is a country wherein there is a shadow of war. People don't want to commit money in Taiwan. So in emerging market space, India stands out, and India will attract giant inflow of FPI's money when they usher in. So this is where India today is. We are at the cusp or the beginning of a large inflows that will flow into India, and we have just seen glimpses in the last 1 month. So in India, all sectors will not perform simultaneously. Some sectors will lead and some sectors will lag. But eventually, India as a country will deliver double-digit growth. In nominal terms, we believe 10-12% is absolutely easily achievable on a sustainable basis. And when countries around the world realize this, a large amount of inflows will come in, and India will have a massive bull market that is ahead of us. So this is broadly where the macros, where we stand in terms of India. So in short term, as I told you, all sectors will not perform, and therefore performances for asset managers will therefore reflect those short-term fancies, mood of the market. But we believe in the long term, all our portfolio companies, all the sectors that we have invested, all the sectors that we are overweight in, will deliver far higher return. Our single goal is to deliver high risk-adjusted return in absolute term for our investors. And with that in mind, with that in focus, we have built that portfolio. So from now, so I will pass on to Mrs. Nirali Bhansali, who will cover in detail our performances, our portfolio stocks, and our broad strategy. Thank you. Over to Nirali.
Thank you and welcome everybody to our quarterly FY23 update. I'm sure you would be eager to understand our side of the story in terms of how are the stocks performing, how are we behaving, and why we have the exposure to certain sectors that we have. So before I get on to the performance part, let me first give you all a brief about what changes we have made in the portfolio in the current quarter. So this disclaimer will apply to all of our slides going forward. Since the inception of the fund, our AUM has grown by 22%. So from 552 crores, which was at the inception of AUM, it has risen to 675 crores now. And we are a growing fund, added a lot new members to our Samco family. So number of folios have also grown from 51,200 by 20% in a span of 7 months to 61,400 now. So we are very happy that we are growing, and thanks to all of you all. Moving on with the portfolio and what changes we have made in the portfolio. So simply put, we follow a very simple E3 strategy. The first leg of the strategy is we buy only efficient Hexashield tested companies. Now with efficient companies, because of efficient companies in our portfolio, our adjusted return on capital employed is 33%, whereas Nifty benchmarks our adjusted ROC is only 22%. So that's why our companies are much more resilient, much more efficient in terms of quality, in terms of fundamentals, and therefore we have been able to deliver a higher adjusted return on capital employed. Coming to the second leg of our portfolio, which is we try to buy them at an efficient price. So we have been allocating funds very, very strategically, very, very gradually, and keeping track of the efficient pricing, the valuation, and the timing. And because of all of this, we have been able to save the portfolio from around a 5% underperformance. So therefore, simply put, if in case we would have allocated all of our money in one go without looking at the efficiency in prices, without seeing the valuation, without gradually allocating and timing the markets, we wouldn't have been able to deliver the performance that we have today. So therefore, we have stuck to our second leg of the strategy, which is we try to buy these companies at an efficient price. Now, because we have already bought efficient Hexashi tested companies, bought them at an efficient price, we have been able to maintain a very efficient churn and cost structure. So the voluntary dealing cost is minimal 0.18% of our overall AUM of 675 crores. And we have made some changes in the portfolio in the past quarter. There have been some exits as well. Let me get on with the exits first before I get on to what we have started to accumulate. So we have completely exited Intuit and Nvidia from the portfolio. Now, the reason behind this is that it was not that we didn't want to allocate more funds to Intuit and Nvidia. And there were actually restrictions on us in terms of RBI not allowing us to add more funds to our foreign portfolio, foreign equity. So this is a blanket ban on all mutual funds at the current time. So therefore, it is not that there was anything wrong with the businesses or with the fundamentals of these companies, and we would have liked to allocate more funds to Intuit and Nvidia. But because of these restrictions and because Intuit and Nvidia were contributing a very minimal percentage to our portfolio. So instead, actually, Nvidia just was like a 0.16% of our total AUM, and Intuit was 0.9%. So even if there would have been a change in the prices, the NAV wouldn't have been impacted significantly. So we took a tactical decision to actually consolidate our portfolio on the foreign side and instead look for opportunities in India. So that was our reasoning, and that was actually the first portfolio churn that we have made in the past 7 months. And that was also a tactical call that we had taken. Coming to Muthoot Finance, in the recent fact sheet, you all would have noticed we have completely exited Muthoot Finance, and I'll elaborate more on what led us to do it and what led us to exit Muthoot completely from the portfolio in the next slide. But so what we did was on the India side, where we have started to accumulate funds is Godrej Consumer Products, Balkrishna Industries, and Aditya Birla Capital. First, let me get on with Muthoot and what was our reasoning to completely exit Muthoot. Now, in the past quarter, something has dramatically changed in the gold finance industry. And it is not that there was no competition earlier. So there was competition back in 2019. In fact, these gold lending players did experience a lot of competition back in 2009, 10, 11 as well. But in this particular quarter, something dramatically changed and the intensity of this competition drastically increased. Because of that, you can see from Q4 of FY22 to Q1, that means in the current quarter itself, these competitors have managed to grow their gold loan AUM by a 6%. So SBI grew by 6.8%. Federal Bank's gold loan AUM grew by 6%. Again, IIFL, HDFC Bank, all of them have seen a dramatic growth in their gold loan AUM in just 1 quarter. And Muthoot, which was the leader in this space, it should have actually given at least an at par performance to the industry, or if not above average, but it degrew in the same quarter. And that was the first crack that we saw. So we were rather proactive about it. We did not want to wait and hold Muthoot because we could already see a declining trend in terms of the market share. And we have no visibility in sight as to when this is going to rebound. There is another reason, actually, if you see the management con call. So to the right, if you see, this is the management con call and what the management feels. So earlier, before getting into Muthoot Finance, we had also gone through the con call reports to see what the management sees from this gold lending space and where it sees its growth itself. So earlier, they were saying that they were expecting a 15% AUM growth in gold loan business. Later on, by FY22, they actually declined it. They said from 15% it will fall down to around 12 to 15%. We were still comfortable with that because we could still see a certain amount of growth, and the management did sound confident at that point in time. But then in this particular quarter, what happened was they were sounding very underconfident. They, from the 10 to 15, 12 to 15% guidance, then they started saying 10% plus, 10%, 12%, 15%. So there was a lot of hesitation there. There was a lot of underconfidence there. And that was also a major reason. So we did not want to just be in the business where there is no earnings growth or no clear visibility of growth going forward. And we thought it best, instead of reacting later, it was the best time. And in fact, we instantly decided to exit this stock because we are invested in these businesses where we see growth. We have only 25 stocks, and where we have full conviction, that's where we want to be invested. So therefore, we look for a better compounding ability, completely exited Muthoot Finance, and in fact started allocating money towards AB Capital. So AB Capital, Aditya Birla Capital, is a gem. So it's a hidden gem that we found because you can see that Aditya Birla Capital and Bajaj Finserv, both of them have been the only players to have given consistent PAT growth. So AB Capital has been growing at a CAGR of 19%. And in fact, if you see, Bajaj Finserv is the only other player in the sector, in the industry, who has been growing consistently in terms of its PAT. But the others, Chola, Shriram, Motilal Oswal, Edelweiss, L&T Finance, all of them have been showing volatility in their PAT growth. So therefore, this was one very strong reason. Another reason was that AB Capital, with a much smaller book in terms of its lending, it still manages to borrow at a similar yield as a Bajaj Finance. So Bajaj Finance has the highest lending book right now. It is over 2 lakh crores, and with a smaller book size, also it has been able to borrow at the same rate. So 6.6% rate is it borrowing. So because of these two reasons, we feel that the company is in the right trajectory of growth, and it is available at dirt cheap valuations. So AB Capital currently trades at a price to book of 1.8 times, whereas the industry average currently is 5 times, 6 times. Bajaj Finserv trades at around 9 times. So this is where you're getting such a brilliant company, a fundamentally strong player at dirt cheap valuations. And therefore, we definitely saw the conviction in terms of growth, in terms of future earnings ability, in terms of compounding from this company and this business. So we started accumulating. There is one other cherry on the cake when it comes to AB Capital, and that is there is a new CEO currently running the show. So Vishakha Mulye has recently joined the company, and she used to be the CFO at a leading private sector bank earlier. So there is a lot of experience she has gained, and with all this knowledge that she has garnered in her with her past experiences, we feel that AB Capital is in good hands, and there will be a lot more growth going forward. So therefore, we have the conviction in this company, in this business, and we have started allocating and accumulating, in fact, AB Capital to our portfolio. There is another stock, Balkrishna Industries, which we have started to accumulate recently. And what do we see in Balkrishna Industries? So basically, Balkrishna Industries, you can take it as a proxy to the auto sector. And auto has a lot of cyclicality. But with Balkrishna Industries, we are actually removing the cyclicality. Now, why do I say that? Because it is not a typical OEM player where the revenue is linked to its volumes. It is actually into the replacement category, and 60% of its portfolio is contributed by agriculture alone. So irrespective of seasons, farmers always require tractors, commercial vehicles, and that's where BKT's demand comes. And BKT is different in terms of its competitive advantages as well. So it has been able to maintain its EBITDA margin at around 31%, whereas its peers, which is MRF, CR, Apollo Tires, Goodyear, they have been delivering a 12 to 15% EBITDA margins. Now, why is that? because BKT is the lowest cost producer, so it actually supplies tires at 20% discount than its industry average. And because of that, it has been able to deliver these stupendous EBITDA margin growth. So if you see, in fact, this discount that it offers in terms of its price, it's expected to go down further by 10%. And this will impact, in fact, this will help to boost its EBITDA margins going forward. What other differentiating factor we saw in Balkrishna Industries was that it has built a very strong brand for itself. So that intangible value that it has built, the free cash flows that it has, the higher number of SKUs that it has, all these factors together has enabled it to deliver an average ROCE of 20-21%. So therefore, this has definitely been translating into the price, and therefore you can see from 2009, it's been going up secularly. So this is on a secular up move, whereas if you compare that to the auto sector, it is here. So auto sector has delivered 750% returns in terms of annualized returns, basically, and Balkrishna Industries has delivered 5,947% returns. So this is where we are at, and this is why we have conviction in Balkrishna Industries. Coming to the third stock that we have recently allocated and started to accumulate in our portfolio, it is Godrej Consumer Products. So now in Godrej Consumer Products, again, there is a new management, there is a new CEO which has recently joined, and he comes with a strong background of experience, and we feel that he has a lot to add to the table, and he's already bringing about a 360-degree change in its game plan. So a very strong strategy that they have in place. What are they doing is they are improving their cost initiatives. So basically, they are cutting down their costs, their overhead savings. They are not spending very heavily on media spends. And all of this will help them improve their gross margins and EBITDA margins going forward. One other thing they are doing is they are very focused in their approach. So it's not that they are using the same strategy of investments in every category, in every region. They are very focused. They know that this category in this particular region will need distribution to work, or this particular category in some other region would need more media spends. So that's how strategically they are dividing their investments, and therefore they themselves feel that their volume growth will touch double digit. And with all these changes that they are doing, they feel that with the penetration gains, the market share gains, the consumption story, as India continues to grow, the consumption story will play out. And with all these innovations, Godrej Consumer Products will definitely stand out and will continue to deliver strong returns, strong earnings growth going forward. So because of these reasons, we have started to accumulate Godrej Consumer Products, Balkrishna Industries, and AB Capital. So together on a consolidated basis, we basically have robust quality 25 businesses that we own with our Samco Flexi Cap Fund. As of August end, we have deployed 93% of our AUM, and asset allocation is 88% is to India, Indian equities, 5% is to international equities, and 6.2% we are holding as cash currently. With these 25 stocks now, we are underwriting 7 different themes. So therefore, we have exposure to 7 different themes with our 25 stocks. We are quite bullish on cloud and digital, financialization of savings and lending as a theme. As India continues to grow, the consumption story will play out, and with the increasing capex, etc., by the government and by the central government, basically, we feel that infra and auto are also continuously growing. We are also very bullish on future technologies, which is EV and autonomous vehicles. So therefore, we have an LTTS in our portfolio. With the platform businesses exposure, there will be a two-way network effect. So that will also play out in the future. And healthcare and pharma are evergreen sectors, and therefore we have exposure to very niche companies and niche businesses even in healthcare and pharma. So together on an aggregate basis, we have 25 efficient, robust companies in our portfolio. Having said that, it is also a very well diversified portfolio. As I already mentioned, we have exposure to chemicals, IT, finance, consumer durables, pharma, auto, leisure services, etc. Even in terms of market cap, we are definitely and truly a flexi cap fund. So 57% large cap, 26% mid cap, and 9.6% is the small cap exposure. So this is the portfolio in terms of market cap split. We also continue to be different than the benchmark, and therefore our active share still stands at 90.58%. Now, what leads to this high active share for us? If you see the top 10 constituents of the benchmark and Samco Flexi Cap Fund, there is only one stock which is common between the two, and that is TCS. So TCS in our portfolio is 8.17%, whereas in the benchmark, it's around 2.8%. So because of this difference, you can see it is definitely showing in our active share. Also, the exposure to certain sectors. So we don't have direct exposure to certain sectors. So we don't have direct exposure to construction and reality, metals and mining, oil and gas, and power in the portfolio. So because of this as well, we have been able to generate and deliver a higher active share, which is 9.58%. But there is one other factor actually. Even if you see on the basis of market cap, we are very different in terms of the small cap exposure that we have. So this is where Nifty 500, so in the benchmark itself, large cap has 72.9% composition, whereas in our fund, it is 57%. So there, in terms of large cap, you can say that we are lesser by 15%, but we have a significant amount of small cap in the portfolio. So we are at 9.68%, whereas in the Nifty 500, it's just 0.23%. So here is where the difference also lies along with the large cap. So this is how we are different than the benchmark, and we are truly an active fund. So having said that, this was all about the portfolio. And now coming to our quarterly results and how our businesses have performed in the recent quarter. If you see on an aggregate basis, our weighted average in terms of top line was very strong, very robust at 27%. Our PAT growth has also been around 43%. So businesses have been continuously doing well, and it was not that this quarter was weak for us at all. In fact, it was a very, very strong quarter. So our top weightages, which is Bajaj Finserv and Bajaj Finance, continue to deliver 30% growth. So Bajaj Finance actually contributes a major portion to Bajaj Finserv, and you can see Bajaj Finance has delivered over 30% growth in its top line, 158% growth in its PAT. And even going forward, the management continues to remain very strong in terms of its growth, and it's in fact going to continue to focus on its margins. In the financialization of savings and lending space, again, AB Capital, ICICI, GI, both these companies continue to do very well for us. So AB Capital, 30% top line growth, 56% PAT growth, and the management's commentary has also been very strong. They see a growth of 20% with ROE is going to be at around 15 to 17%. With ICICI, GI, management expects the combined ratio to in fact come down. So with this exposure that we have, the stocks that we have in the financialization of savings and lending as a theme, they have performed very well in the past quarter. And even going forward, the management sees the growth from this sector. Coming to the next the exposure that we have, or the next sector that we hold currently, which is technology. The four stocks in the IT space, which is TCS, Coforge, LTTS, Mindtree, they have also given very strong top line growth. So if you see this 25%, 23%, Mindtree 36%. PAT growth again very strong, and an average 35%, 36%. And if you see the management commentary, there is so much confidence in this commentary. So Coforge's management, they see a 20% growth going forward. They see 18.5 to 19% margin guidance going forward. Even LTTS, EBIT margin guidance about 18% going forward. Mindtree, EBITDA margin at 20% going forward. So you can see that the businesses, the quality of these IT companies have continued to remain strong. The management still sees the deal wins coming in. They still see the order book going strong. So there is no issue per se with the fundamentals of these businesses. Then coming to our exposure to the consumption story. So Jubilant, Pidilite, Asian Paint, Crompton, Supreme, all of them have done a stupendous, given a stupendous result in terms of top line and in terms of PAT. So you can see 40%, 60%, 54%. Even in terms of PAT, 60%, 80% with Asian Paints. Even going forward, the managements feel that there is a lot of room for growth. So Jubilant, in fact, is opening more stores. Pidilite is going to focus on its volumes. Asian Paints, irrespective of all the narratives out there about crude oil going up and down, inflation coming back, it still continues to have the pricing power. And you can see it even in its current result, and the management still sees their gross margin to be around 38 to 40%, despite all of this inflationary pressure that you see out there. Crompton, again, it sees the benefits of commodity price reduction actually translating into its margins and price going forward. Supreme is also very confident of recouping its lost ground. So with all these companies, we don't see any issue in terms of the fundamentals, in terms of the future guidance which the managements have given. Even with our exposure to the FMCG space, there have been good single-digit growth, but going forward, the management see their gross margins to expand. They are saying that they will be able to maintain EBITDA margins at the current level. So again, with the FMCG space, no issue at all. The quarter has been very strong. When it comes to Divi's and JB Chem, which are the niche stocks that we have in the pharma space, again, very robust top line and margin guidance going forward. So Divi's, they see that the EBITDA margin is expected to be at 40%. With JB Chem, gross margin is expected to be at 64%. Again, with Chem, strong double-digit top-line growth and EBITDA margin at 40%. Even if you see the exposure of our portfolio to the foreign stocks, so we have 6 stocks that we hold in the US. So over there as well, the top line and PAT growth has been strong, and management still expect double-digit revenue growth, organic growth, margin growth going forward. So overall, the quarter has been very strong for us, and we continue to see the conviction in our stocks in terms of the fundamentals, in terms of the businesses that we hold. So on a consolidated perspective, for our portfolio, our adjusted ROC is at 33%, Nifty's is at 22%. Our gross margin is much higher at 64%, 65%, whereas Nifty's is at 41, 42%. Our debt to equity is much less. So we are not very heavily levered in a high interest rate scenario, which is good for us. So therefore, debt to equity is 0.23. Nifty's is at 0.72. Even in terms of other financial services companies that we hold, our ROE is much stronger at 23%. Nifty's is at 18%. And our CAR, which is capital adequacy ratio, is again much higher than the benchmark at 27%. So on a consolidated perspective as well, even on the particular quarter, we continue to see the growth, the earnings growth with our businesses. We continue to see the free cash flow being reinvested into these businesses, which will enable higher compounding going forward. So therefore, this was all about the quarter, and now moving on to the portfolio performance. So I'm sure you would be eager to understand how these fundamentals are actually translating into the stock price, and how we see the stock price moving forward, or how we see the performance of the portfolio going ahead. So firstly, let me just throw some light on the performance in terms of annualized returns. And we have been showing this from the current fact sheet. So if you see August fact sheet, we have underperformed the benchmark. However, if you even look at it from a month-on-month performance, let's dissect it over here. So February and March, we were still allocating funds. It was not that the initial money that we had got during the inception, during the NFO, was completely allocated at the same time. So we took our time, and gradually by looking at the efficient price we were allocating in February and March. Then April, May, June, yes, there has been a cumulative 3% odd underperformance. But then in July, our rebound was very strong. So from negative 7%, you can see the rebound to 13%. And because of that, the performance jumped. So there was a 4% outperformance to the benchmark. Now, why is this happening? And what led to this? So y'all have invested in equities and y'all are coming to us not to be invested for a month's time or 2 months time or a 3 months time. We are here, and what we have been trying to communicate with y'all is that y'all should be invested for at least a 3-year, a 5-year horizon. Because what happens is, in the short period of time, these prices are all a function of demand and supply. So there will be sentiments, there will be news flowing. Because of that, these prices keep moving on a day-to-day basis. And it's not that these fundamentals get translated into the stock price and they move every day because of the fundamentals. So fundamentals continue to remain strong, but it's not that all of that is getting translated to the stock price on a day-to-day or a month-to-month basis. So there is a 3% odd underperformance. That's fine. We are well aware of this fact. And in fact, we feel that we have the right ingredients in place so that this outperformance happens. And we have been saying since the start that 2/3 of the times we will outperform, 1/3 of the time we will underperform. But when we will outperform and rebound much stronger. Because we are not here to run a trading fund, and we are here to actually build assets for investors over the long term. So what we did was we have dissected this down even further to see on an attribution analysis basis what have been our top contributors and what have been our top losers. So if you see Bajaj Twins, so Bajaj Finserv, Finance, Pidilite, Jubilant, Asian Paints, all these 5 stocks have been our top contributors and top winners. Whereas Coforge, LTTS, TCS, mainly the IT sector have been underperforming for us and being the losers for us. Now, why are they the losers? As I already told you, the fundamentals are strong. There is still earnings growth. You can see it. The management is very confident of the demand. The management is very confident of deal wins going forward. Then what is the issue? Why are these stocks our top losers? So that is a question that we should ask ourselves, because fundamentally there is nothing wrong with these businesses. Issue is FIIs. So FIIs have been selling since over a year now. So April, May, back in FY21, even now, June, in fact, the intensity aggressively increased. So FII started selling more and more. And that's where you can also see the impact on our stocks. But something changed in June, and the FII selling over here drastically reduced. So this drastic reduction in FII intensity of selling, you can immediately see in our returns. So here is the outperformance. So when FII started selling lesser, so the aggressiveness in the FII selling reduced, that's when you can see this outperformance, this 4% outperformance. And why is that? Because our stocks are darlings of FIIs. So even if you see our top weightages, which is the Bajaj Twins, TCS, Coforge, all these have a very high exposure, very heavy exposure to FIIs. And even the technology space where we have exposure to, they are also FII darlings. But whenever, so FIIs have been selling aggressively since a number of months now. And whenever this tide turns, you can see very clearly how efficiently, and you will be able to actually see the outperformance in the portfolio once this tide turns, because our stocks are very heavy FII stocks. And we know for a fact that what has not worked in the portfolio, and we are very fine holding it, because we know that we have the right ingredients in place and there is nothing wrong with the fundamentals of these businesses. It's just a macro factor which is affecting, which is FIIs, and that also very clearly visible. When there is a rebound, there is an outperformance in the portfolio. So this Nifty IT has underperformed compared to the benchmark. But again, when we went back in time to see what the impact was, let me show you. So back in during the dot-com bubble in the Nasdaq, you can see very clearly that this rally was basically not because of earnings growth. It was not because it was backed by positive cash flows. It was mere because of herding behavior, because of FOMO, because of sentimental factors, and because there was no earnings backing these companies and these stocks. The fall was also very drastic and dramatic. So the drawdown in Nasdaq at that point in time was 77% from its highs. Similar situation played out even now in the ARKK Innovation ETF Fund. When when the stock started going up, when it started rallying, there was no earnings backing it, and there was not much positive free cash flow backing this up move. Because of that, the fall was also very steep and it fell down by 75%. Technology fund, again, Invesco China Technology ETF, you can see a similar situation that has played about. But what is different now is, now Nasdaq's composition has changed. So Nasdaq has Apple, Google, Microsoft, which are very cash rich companies and businesses, and they are showing double-digit earnings growth even today. So it's not that the Nasdaq is not backed by strong companies and strong businesses now. So therefore, we feel that the tide has definitely come to an end, and we feel that we are near the bottom in the technology space. And from this point onwards, the fall will not be as steep as you can see over here, because the earnings are there to support it. The managements themselves, they're part of these businesses. They're the insiders of these businesses. So they know that they can see the demand going forward. And something else has also changed in this industry and in this sector in the past 2 years. That is COVID. So COVID has made all businesses and industries realize the need for technology. So this is a McKinsey report where you can see very clearly, be it automotive, chemical, construction, education, healthcare, finance, IT, media, all these industries have started using technology in some form or the other. Cloud and AI ML are the top technology trends which all industries have started to imbibe in their businesses, because they can see for themselves that all of this technology implementations have been leading to increasing productivity. It's been leading to a lot of efficiency in supply chains. Because of that, in fact, because of cloud computing, McKinsey expects a $1 trillion EBITDA improvement in all Fortune 500 companies. In fact, with ML applications, the production time is going to reduce by 90% from here. So that is the need for technology now. So it's no longer a discretionary expense. It's now become a primary expense for businesses, where it's linked to the core of the business, where it's linked to the expansion strategy of the business. It's also linked to the everyday workings of a business. So it's become a real need of the hour. And coming to India again, the Gartner and Ascom, they themselves feel that there is a 69% growth potential in Indian IT industry going forward. So this is the potential that they themselves see with India and Indian IT players. So therefore, when there is so much negativity around, there's so much news around, when there is so much fear around in the industry, in fact, that's the time you hit hard and you go aggressive in technology. When everything is bad, when everything is fearful, that's when you start to accumulate. And you can see these businesses. So in the last 12 months, Mindtree has grown 19%, Coforge 29% growth in earnings, LTTS 15% growth in earnings. But at the same time, the stock prices gone down by 36%, 39%, 45%. And what is valuation? Valuation is nothing but price divided by earnings per share. Now, price has fallen, earnings per share has risen. So, isn't it a good time in terms of valuation? So, the effective correction in valuation is, in fact, very attractive. So, 58%. If you just on a mota moti basis, if you do like a 19% change in LTM earnings, change in price negative 36%, and an effective correction in valuation is 58%. So that's the margin of safety that you have if you invest in technology companies and very strong businesses at this point in time. So therefore, you should not look at the small sentimental news and all the ownership changes that happen in IT. And you should aggressively actually invest and accumulate IT at the current levels. Having said that, IT as an index has actually made strong wealth in terms of returns and risk for an investor in the long term. So this is basically nothing but Nifty's Sharpe ratio since inception. And IT has continued to deliver a very high Sharpe ratio at 0.49, which is in fact one of the highest among all the other indices. And we are currently overweight in IT. As you can see, nothing wrong with fundamentals. You can see this is an FII impact that you see in the stock prices. And there is a lot of growth potential going forward. So we are overweight in IT, but we feel and we see the growth coming into this sector, and this is the time to accumulate. We also have exposure to consumer durable, healthcare, and pharma, where we are overweight, but yet again, a very high Sharpe ratio, which is nothing but return divided by risk. We are not present, in fact, in the sectors where there is a lower Sharpe ratio. So if you see oil and gas, metals, who are very, very cyclical indices, there, those sectors we don't have exposure because the Sharpe ratio is only 0.23, 0.07. So overall, we are very confident and have the conviction in the exposure to sectors that we have currently and the stocks that we hold in the portfolio, because we are sticking to the winning horse in the race. And so if you compare a couple of examples, basically, if you compare the stock in our portfolio, the businesses we own compared to their peers, you can see that from Y2D performance from January to now, they have actually outperformed. So TCS has definitely from January to now has actually outperformed in terms of charts compared to an Infosys, HCL Tech, Tech Mahindra, or a Wipro. Even if you see the paint sector, Asian Paints continue to outperform and AkzoNobel, Kansai, Berger, etc. Adhesives, again, Pidilite has done very well for us compared to an SRF, Astral, Aarti Industries, or Deepak Nitrite. Even if you see the AMC space and where CAMS is here in the middle. But have you seen the fundamentals of CAMS? It has given double-digit revenue growth, whereas the other names, Aditya Birla, AMC, or NAM India, or HDFC, or UTI, they have given single-digit growth in terms of their top line. So therefore, once these fundamentals start translating into the stock price, this stock will definitely reflect the same and will continue to be one of the top performers compared to its peers. So we continue to stick to these winners where they have the potential for earnings growth going forward. We see the conviction in the prices going forward. We see the conviction in the earnings growth and the compounding that will play out over the long term. So we don't really need to be smarter than the rest. In investing, we just have to be more disciplined and we have to be more patient, because there will be news, there will be short-term sentimental factors affecting prices, but that doesn't mean that the businesses are affected. And we are continuously looking at these businesses, continuously seeing the fundamentals of these businesses, and fundamentals will definitely have the last laugh at the end of the day. So underperformance is definitely a good time to accumulate these businesses, very strong, robust, efficient businesses in your portfolio if you want to create wealth over the long term. So yes, I hope I have addressed all of your concerns. And still, if you have any more questions, please feel free to write to us in the comments section. And yes, let's get on with the Q&A.
Thank you, Nirali. A lot of questions has come to us through the mails, and we have addressed most of it. I am just taking a note of most of the questions that we have addressed. Apart from that, all the remaining questions are what we are looking at to address in the due course of time. So we got a question from Dilip Kumar Das from Mumbai regarding inflation and interest rate, which has been addressed. We got the question from Lucknow from from Shakunta Das Gupta as to about our investment into the flexi cap category. We also got a question from a lot of people for about our exposure to IT sector and the underperformance due to that. The question has come from Abhay Kumar, also from Calcutta. We have got a question from Anil Hari Kumar from Mumbai as to why the NAV is below 10 rupees, which is also addressed. We have got a question regarding our strategy on Muthoot Finance as to why did we exited this particular thing. We got this question from 3-4 people, particularly from Shilpa ji from Bangalore. We also got the question from Deepak Gulati from Dehradun about our exposure to IT sector. So most of the questions were regarding IT stock, our underperformance, and also on Muthoot Finance, which we have tried to address. There are a couple of more questions which are being given to me. There is a question from Anjali Singh from Delhi about our outlook on Divi's Lab, which is a part of our portfolio stock, and also our current allocation. If Dhawal, you can take on this particular question.
Sure. So thank you, Anjali ji, for your question. So we have rebalanced our portfolio and have brought down weightage of Divis from 5.84% in April 2022 to 3.14% currently. So Divis has, focused portfolio of close to around 40-45 APIs with limited Chinese competition, which is backed by a novel chemistry process. And Divis is one of the world's largest API producers. So management has currently identified and laid down six growth areas, which are established generics, existing generics, new generics, sartan APIs, which is the cleaner way of production, contrast media, as well as custom synthesis. And what we believe is that, we believe that concentration on these areas would help Divis achieve the next phase of growth. And even talking about fundamentals, Q1 bottom line was affected due to increase in cost of raw materials and shipping cost. However, the management is quite positive about maintaining a 40% operating margin and the growth going ahead, which shows that they still have the pricing power intact. And this gives us confidence to remain invested in Divis, even with uncertainty around the revenue from COVID-19 API. I hope this answers your question. Thank you.
Also, there is one more question as to why there are no banking stocks in our portfolio, particularly from Ajay Singh ji from Hisar.
Okay, thank you, Singh ji, for your question. So we have underwritten lending themes through few resilient and fastest growing NBFCs. So the thought process behind choosing an NBFC is that, usually banks, they operate with NIMs of 2 to 4% and have the ability to grow close to around 1 or 1.5 times the GDP growth. However, these NBFCs have the ability to operate with 12 to 13% NIMs and have the ability to grow much faster with growth of upwards of 25% for at least the next few years. So we have taken exposure to niche NBFCs, which are ideally best at what they do. And this is why we have taken a good amount of exposure to Bajaj Finance and our new entrant, Aditya Birla Capital.
Also, Dhawal, if you can throw some light on our fund as to how we are different than most of the other funds listed on the same categories.
Okay.
Particularly, this question has come from Gitika ji from Jaipur.
Okay. Thank you, Gitika ji, for your question. So as Umesh sir said that, so our aim is to run the best fund ever. And by best fund, we mean that to generate the highest risk-adjusted return over the long term. Having said that, we have few nuances which sets us apart. So we have built our proprietary Hexashield framework for our investment process. We believe in growth strategy, that is to invest in companies with highest growth potential. We truly are an active fund with an active share of 90.58%. That is, we are more than 90% different from the index, and therefore you get a truly differentiated product from the benchmark. And lastly, it's a strict 25 stock portfolio with the right balance of diversification as well as concentration across companies and sectors. So these are the 5 big reasons that Samco Flexi, which makes Samco Flexi Cap Fund different from majority of the funds out there. I hope this answers your question.
Thank you, Dhawal. Another question has come from Sanjay Patwardhan ji from Mumbai. Umesh bhai, if you can take this particular question as to what are the other products that we are looking to launch in the coming few months.
There is something very, very exciting that we are coming out with. So hopefully in short time we will announce that and our team will get in touch. But let me give you a promise that yes, we are coming and we are coming very soon, and it will be a very, very differentiated product again for our partners and our investors.
Another question is it the right time to do lump sum or SIP at this moment, Umesh bhai?
So currently, given the market is climbing the wall of worry, uh, prices have run up quickly. As I told you, 2,500 points in Nifty. So this is a consolidation phase, and given that globally geopolitical situations are going to disrupt some amount of businesses, so this is an ideal time to accumulate. And our internal assessment is that market is currently not extremely overpriced, not underpriced, and therefore this is an ideal time to accumulate. And therefore, instead of lump sum, SIP for few quarters would be a preferred option for investments.
With the constant of time, we are exactly at 5 now. With the constant of time, we have tried to answer as many questions as possible, guys. If you have any more questions, you can write a mail to all of us. We will be happy to address it, and looking forward to connect with all of you again in a very short period of time. Thank you very much, and thank you once again for putting your faith in us and allowing us to be your money managers. Thank you once again.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.